a lot has happened since I think we did the last round 12 months ago here in the same room. A lot more positive news to be shared, luckily. I will touch very briefly on the economic side of the investment equation. A lot of good news there, at least we hope, and I hope it will continue like this. Of course, a lot of all of this is depending on how the issues in the East are going to pan out and how that is going to influence the economies around Europe in particular and its impact on the real estate markets. I will touch on the traditional investment flows, where's the capital lending and how do we see that developing on the debt and equity side. We will then touch on some outlooks you may agree with, you may disagree with on rents and yields. We generally feel that there is currently a lot of capital out there that is going to push yields down somewhat in some of the segments. And I have to say I focused on offices in this case because there is not time enough to go into all of the segments. The panel will pick up on the other segments as well. And then some scenarios is what Richard shared already on Ukraine, Russia, and how that potentially spills over into the rest of Europe. Changing economic growth patterns in Europe. Good news, overall the sentiment has turned for the good in almost all the countries in Europe. These are numbers from Oxford to be expected over the next 2 to 3 years. Three major trends. Germany is performing quite strongly, obviously very important for the rest of continental Europe. The UK is also clearly above average and is pushing ahead in terms of economic growth, which is also panning out on the real estate market. And then in the southern part of Europe, France, Spain, Italy, growth is there, it's visible, but it's not going that quickly as what some people may have hoped for. There's a lot of capital at the moment moving into the southern part of Europe, and the hopes are that the economies are going to pick up more substantially than what is currently visible. And I'm saying this into a bit more depth because we generally feel that most of the competition on Central European assets will come from investors that may also look into Spain, Portugal, and Italy. And if you compare the growth statistics that are expected by the main forecasters, Central Europe is going to see more economic growth over the period that I stated than the southern part of Europe so far. There's a lot of capital around across the globe, increasing amount of equity, increasing allocations to real estate, but we also have the feeling that there's more and more debt coming into the markets. And that is resulting in increasing flows of capital into commercial real estate in Europe. These are quarterly volumes since, let's say, the crisis. There has been a very steady increase of volumes moving into commercial real estate. And the last quarter of last year and the first quarter of this year have been records since the crisis kicked in. So it really shows you how strong the market currently is, and there is a stronger and higher allocation generally, and more new players coming in as well. The orange line is indicating the CE share in these volumes. It's a bit volatile, but overall you can expect 5, 6, 7% of total European money to land in CE. The way we look at CE, it consists of, let's say, the whole environment eastward of Germany up to Turkey. We don't include Turkey in these volumes. Roughly 50% of the investment flows for 2012 on the left-hand side and on the right are Russia. And if you would exclude these, we're looking at an investment universe of around 4 billion in 2012, increased up to 5.6 billion in 2013. So there also very, very substantial growth visible. The strongest market beyond Russia is Poland, around 30 to 35% of the total CE volumes, and increasing. Still the investment darling in Central and Eastern Europe, I would say, beyond Russia. And then the smaller markets like the Czech Republic, Romania and Hungary. And the good news there is that due to the money pressure in the market at the moment, there's more liquidity flowing into these markets as well. Czech has always been, let's say, of interest to investors. It remained a bit silent over the last 1-2 years, but it's picking up now substantially, particularly on the industrial side, and the retail side is of high interest. But Romania and Hungary are also gaining traction. So you start seeing the wall of money, let's say, moving into the other geographies of Central and Eastern Europe now as well. Just to focus a bit on the biggest countries, in Poland, we, based on the pipeline that we are currently working on and are aware of concrete deals that they are expected to land in this year, the increase of volumes we've seen happening over the last couple of years is going to continue. For 2014, we're expecting another, let's say, record year since the crisis kicked in. So only 2006, in historical perspectives, is expected to be stronger than 2014 is going to be. So from a liquidity point of view, positive news, I would say. I'm sure that Mike will go into this in more detail later on. On the Russian market, there were a lot of talks about the Russian investment market falling off a cliff. This is an unfair comparison that I put on the screen at the moment, annual statistics versus the Q1 2014 statistic. Q1 wasn't particularly strong, but if you look at the Q1 on Q1 changes, it hasn't actually been that bad. And last year was extremely strong on the back of a couple of very large deals that took place there. One of the largest shopping centers in Russia was sold in Q1 last year, and that obviously caused a spike. So, but what we need to be aware of is that generally foreign investors, particularly US investors, are getting more cautious with Russia. And maybe Gordon can mention more detail on this later on. And this is what we're also seeing in the occupational markets, particularly the industrial market in Russia, is that foreign occupiers, again, mainly from the US, are getting very cautious, and some of them have already canceled deals or postponed deals that were on the way. So we're starting to see implications there. But as we all know, a lot of the capital in Russia is local. Around 60 to 70% of capital flows there are still, let's say, Russian money, and this money is still moving into real estate. And yesterday, I think, Richard, in your magazine, you had a statement on Goldman Sachs buying into O1 Properties, a stake of around 6-7%. So it seems that some of the parties are now getting in there indirect. So the market is still very attractive. How we see, let's say, the money is structured in the European real estate market. Overall, a very, very strong increase of equity, and that's the dark green color. If you compare the actual levels of equity in the market and compare that back to the situation in 2006 and 2007, you can see there's actually more equity in the markets than in, let's say, the peak years back then. As I said, that's being driven by the fact that there are more and different parties active in the commercial real estate market at the moment, and also the allocations are going up. On top of that, we haven't really seen a recovery of the debt side, but I mean, Martin and I have done a couple of conferences over the last months, and it feels that the banking sector is under pressure to increase LTVs. So the expectation is that also on the debt side, we're going to see more money available, and as a consequence, this line is probably going up over the next 1-2 years, with risks, obviously, of overpricing, particularly on the prime end of the market. Which is a nice bridge to the investor intention sentiment survey that our European team generally launch at MIPIM. Just one slide on this. CEE is generally being seen still as a very interesting market to invest in. It falls quite back behind Western Europe as a region, but still a lot of the investors and developers that we interview mention Central Europe as a very interesting destination of capital. And there hasn't been really a significant change if we compare that to last year. And if you look back into the results of the sentiment survey and the actual investment volumes that we've seen landing in these regions, there's quite a strong correlation. On the return side, there are some interesting changes visible. And I have to say that most of the changes that we are seeing at the moment are being driven by the capital out there. So we generally feel that the yield impact, so the capital growth impact, is going to be more substantial than the rental effect. It may differ a bit per segment. What we've done here is we started off with comparing the Eurostat Economic Sentiment Indicator, a generally accepted way of looking at how market volatility may move forward. And we compare that to our general, let's say, synthetic EMEA Prime Office Capital Value Index. So the way we normally change the value per square meter, in this case, of prime offices. And what you can see is that there's a very strong correlation between the two of them. So overall, assuming that the positive news on the economic side will continue, we generally feel, and let's say linking that with the additional capital that we are expecting to come into the region, there is a very strong basis for increased capital growth in Central Europe. And I will come back to this in a second. I highlighted the gap between the lines in 2012 and 13, and that gap I think can be explained by the fact that there's currently so much capital in the market that you don't really feel an impact of a drop in sentiment versus, let's say, the change in capital value. So overall, the market seems to be very solid on the yield side at the moment. And this is to an extent driven by the fact that we're slowly but surely starting to see a rental growth in Europe. And it's interesting to see that at the moment there's a very, very substantial rental growth visible, all based on prime rents that we quote. But still, in Ireland, in Dublin, went up by 25% year on year last year, coming from a very low basis, but still expected to continue. Also London, slowly but surely picking up speed. Istanbul had quite a solid growth of around 5%, and the German cities 2 to 3%. The rest of Europe is still at a plateau or slightly decreasing, and of interest to us, obviously, the Warsaw market and the Prague market, year on year, 2012-13, showed decreases of around 4 or 5%. If we're looking at one of the drivers going forward of potential rental growth, office-based employment is supporting that story quite nicely. There are a couple of markets where there's particular employment growth at the moment. London, Istanbul as well, so markets where I already mentioned that rents are at the moment already going up. Dublin supporting that as well, but again coming from a very low basis. And of interest to us again, Warsaw with an annual growth of around 2% projected. And sorry, that was the figure for 2013. And if you look into the numbers for 2014 and 2015, these trends are expected to continue. So what we can expect on the back of that is an increase of, let's say, net absorption, not considering pipelines at the moment for a second, but I will get to that in a second. So based on this, stronger economic growth, more office-based employment, more take-up, more net take-up of office space in these cities. But the pipelines. On the horizontal axis, you see the development pipeline under construction till the end of 2015. And on the vertical axis, the vacancy rate. And on the left-hand side, with the exception of Budapest, these are all Western European markets. On the right-hand side, we plotted some of the Central European markets, and you straight away see the difference. So there's a far more substantial relative pipeline versus stock under construction in Prague and Warsaw than you would see in markets like Barcelona or Madrid. And these are the markets that Central Europe, based on, let's say, its economic profile and yield profile, is most likely going to compete with for money. So this is something where investors will need to try to find a trade-off in terms of where they will expect the best returns. We made some projections of rental growth, and please don't try to analyze all of these lines, but again, these are annual growth statistics from 2014 up to 2019. And again, the fastest recovery markets, the cyclical recovery markets like Ireland, like Spain, are coming out very positively. Also, certain parts of London are proving quite interesting based on these numbers. And if we are looking at our markets in Central Europe, Budapest is up there, let's say, of the fifth or sixth market. I generally have to say that I think these numbers are slightly overstated. It's model-based. As we didn't really see a lot of economic growth coming back into the market yet, and we haven't really seen a lot of rental movement there over the last couple of years, I think you would need to cut that rental growth line into two to get more realistic figures. but that's my humble opinion. And then we have Prague and Warsaw projected to be around 2 to 3%, based on what I said, increased employment growth and increased net absorption. But be aware that in Warsaw there may be a bit of pressure still on rents, and let's say in the second part of the next 5 to 6 years, that rental growth may slightly come back. What is more importantly driving total returns going forward is the yields, obviously, and these are driven by the long-term bond rates. We have an in-house view that these bond rates in Germany mainly will need to move back up to around 4 to 5% up to 2020. It is very unlikely that this trend is going to kick in very soon. I think there will be a delay simply based on the fact that economic growth at the moment is not that strong yet, and there is a risk of deflation still in the markets, and therefore it is probably later and not sooner that these bond rates will move up. But when these will go up substantially, we'll feel an impact on yields. And that will bring us now to the yield projections. Overall, based on the amount of money in the markets and the fact that there's probably going to be a delay of bond rates moving up, we feel that there's about 12 to 24 month a yield gap, let's say, or compression gap that we may expect to come through in the Central European markets. And this is something that is differentiating a bit from the larger Western European markets, because some of these markets have already seen more yield compression coming through in earlier days. The model that we are using is ranging from, let's say, 15 up to 20 to 30 basis points for the next 12 to 24 months. On total returns, obviously that is based on the rental projections that I gave you and the outlooks on the yields. So again, the caveat on Budapest, but overall we feel that in the cyclical recovery markets, the total returns are going to be the strongest, driven by rental growth and coming in of yields. Then we have a group of markets, including Prague and Warsaw, where rents sooner or later are going to stabilize, and therefore higher income is going to come through, and there is some room for yield compression. Total returns projected to be around 8 to 9%. And then we have the markets where there's limited yield compression. In our scenarios, the most important implication of total return growth. And that is driven by the fact that these markets are generally already ahead of several others. In terms of the Ukraine, we had a very intense debate internally on how this is changing, and our scenarios are almost changing every second day. Yesterday, Putin had a very interesting statement on the referendum that is planned for, I believe it's this Sunday, to postpone that, which was initially seen as a very positive sign. But this morning I already heard in the news that nobody's really thinking about postponing it and simply pushing through. So it was either a very smart political decision from Putin to say something about it, or it seems that even he doesn't have the situation under control. What we know is that there are presidential elections coming up the 25th of May, not recognized by Russia, by the way. And this is quite an important point, because the US and the EU warned Russia not to get involved into these elections, and if they would, serious trade implications could be applied. And this obviously is a risk that may start affecting the overall economic growth in Europe and potentially globally again. And therefore, if things turn to the worst, we still assume the baseline scenario that in Q2, Q3 of this year, things will start to settle down. But I have to say that that baseline scenario is getting under pressure, more under pressure every week. If things turn for the worse, we have a risk of increased geopolitical risk. A couple of days ago, I heard that even Moldova is already placing its troops on the border. So it's going beyond, let's say, Ukraine and Russia. The situation is getting a bit sensitive in Poland as well, based on historical reasons. We don't really feel an impact on the economic side, on the real estate side there yet. But based on sentiment, the Poles don't like what is at the moment happening at all. We see economic risk, what I said, a renewed slowdown of the European economy, it's at stake. What can happen, but I have to say, Russia, even in the Cold War, didn't decide to cut deliveries of gas and oil to the EU during the Cold War, what I said, but it's a potential cause of increasing energy inflation and FX volatility. I have to say that FX rates at the moment are far more sustainable than what they used to be back in 2007 and 2008. But once the markets, the financial markets, will get into more turbulence, it is most likely going to have an impact generally on rents in Central Europe. In terms of property market risk, I mean, this is a logical consequence of slowing economic growth. We may see a slowdown of occupational markets. It's going to be prolonged in some of the markets, and rents either to remain low or rock bottom or get under downward pressure. This is all probably a bit too early to speak about, but I just wanted to highlight it and use it for the panel discussion.